Copper just smashed through $6.60 a pound in 2026, and gold is hitting its own all-time highs. Now, if you're thinking this is purely about inflation or simple supply and demand, you're only seeing half the picture. What if I told you a silent, escalating tariff war, ignited by a Section 232 investigation in February of 2025, is quietly driving a massive wedge into your everyday costs? We're not talking about some abstract economic theory here. This isn't just a number on a screen for investors like Cathie Wood or Ray Dalio. This is about why your new EV is suddenly more expensive, why home repairs are costing you a fortune, and why the electronics you buy every day are feeling the squeeze. The crucial part isn't just that tariffs were announced by Donald Trump in July 2025, it's the lingering ambiguity around whether those 50% duties hit refined copper or every single derivative product. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Did you know that in January 2026, Goldman Sachs Research revised their copper price forecast for the first half of the year, anticipating even higher prices than previously projected? This wasn't just about typical supply and demand. Copper futures are now well above $6.60 a pound, a jump of over 7% in just the last month, and that's creating real ripples, not just in your inflation numbers, but in the cost of everything from your new phone to electric vehicle infrastructure. And it's not just copper. Gold has also hit record highs, trading above $2,500 an ounce, partly fueled by the same global tensions pushing copper. We're talking about real money here, impacting the prices of goods and services you interact with daily. The lesson here is that understanding these metals isn't just for commodity traders, it directly affects your household budget. What makes this so crucial right now is a silent force, one that Jerome Powell might not be talking about, but Donald Trump certainly did on July 8, 2025, when he announced those 50% tariffs on copper. This isn't just economic policy, it's a geopolitical chess game playing out in your grocery bill and the price of your next appliance. And that sweeping 50% tariff, announced with characteristic bluntness by President Trump on July 8, 2025, sparked immediate and profound volatility, leaving even seasoned investors like Janet Yellen's former protege scrambling for clarity. This was far from a minor policy tweak, it was a substantial 50% ad valorem tariff on all imported copper, set to become effective a mere month later on August 1. The groundwork for this aggressive move had been laid just 5 months prior in February 2025, with the initiation of a Section 232 investigation citing national security concerns regarding critical mineral supply. The immediate impact on U.S. markets was sharp, with the S&P 500 futures dropping nearly 2% within hours, primarily because the scope of the tariffs remained maddeningly unclear. Were these tariffs going to apply solely to unwrought, refined copper, or would they sweep in derivative products, copper alloys, and even components with significant copper content, such as automotive wiring harnesses from Mexico or microchips from Taiwan? This strategic ambiguity alone set off a frantic scramble, profoundly affecting investor sentiment and early price movements throughout late 2025 and into the first quarter of 2026. Consider the dilemma for a manufacturing giant like General Electric. A division importing high-purity copper cathodes for medical imaging equipment could see their raw material costs jump by a staggering 50% overnight, with absolutely no clear guidance on how to adjust supply chains or pricing strategies. The crucial lesson here is that policy ambiguity, especially in sensitive areas like international trade, can often be a bigger market mover and create more long-term disruption than the policy itself. This singular announcement truly set a precedent for future trade actions, signaling a new, more aggressive era of protectionist policies poised to reverberate across global commodity markets, not just copper. It was a stark reminder of how geopolitical decisions can directly translate into immediate, significant commodity price shifts. But beyond these initial policy shocks and their cascading effects, what were the underlying fundamental numbers that truly pushed copper to these unprecedented highs? But here's the kicker. LME cash copper prices, on January 6, 2026, surged to an unprecedented $13,300 per metric ton. This wasn't just a bump, this was a staggering 50% year-on-year increase for copper, a move that surprised even the most seasoned market watchers. Think about that. A 50% jump in a single year. The Oregon Group, on February 3, 2026, highlighted this truly robust demand and undeniably constrained supply. Just days before, on January 5, 2026, benchmark LME copper prices had already blasted past the $13,000 per metric ton mark, setting the stage for this historic peak. For context, imagine you bought 1,000 pounds of copper in August 2025 at, say, $4.40 a pound, and held it. By August 5, 2026, that same copper would be trading at $6.63 a pound, giving you a profit of over $2,200, purely from the price appreciation. On January 23, 2026, Jacob White's Sprott Copper report specifically called out copper's record surge, confirming it had indeed reached all-time highs. Goldman Sachs Research, also on January 23, 2026, responded to this trend by significantly increasing their copper price forecast for the first half of 2026. The lesson here is that policy decisions, like tariffs, can accelerate and amplify pre-existing market conditions, leading to truly explosive price action. This wasn't just about the usual supply and demand, it was a policy-induced shockwave. But while copper was busy making headlines with its meteoric rise, what was happening with gold, and why did its trajectory take such a different turn just months later? But what about gold, often seen as the ultimate safe haven, especially during turmoil? Gold also saw an incredible surge, hitting an all-time high of $5,595 per ounce on January 29, 2026, extending 2025's 60% plus annual surge, its best performance since 1979. Think about that. A 60% jump in a year for an asset usually known for its stability. CNBC reported on January 21, 2026, specifically linking this record-breaking surge, which had gold exceeding $4,800 per ounce, to Greenland tariff threats and global trade war concerns. Breaking Business News reporter Jake Conley even called it an unsustainable metals frenzy on January 29, 2026, making gold, copper, and silver the defining trade of the year. This initial boom, however, was short-lived. Despite that incredible ascent, gold experienced a dramatic correction in the first half of 2026, plummeting over 25% from its peak. This wasn't a gentle dip, it was a significant drop for an asset often expected to hold its value. The World Gold Council's Gold Mid-Year Outlook 2026 highlighted this volatility, showing how geopolitical events, like reports of an imminent deal to reopen the Strait of Hormuz, could suddenly shift market sentiment. When that news broke on August 5, 2026, gold climbed to $4,135.40 USD/T.Oz, up 1.41% daily, reducing inflation concerns and lowering expectations for near-term rate hikes. The lesson here is that even safe haven assets like gold are deeply sensitive to geopolitical shifts and can experience extreme volatility, especially when speculative fervor takes hold. So, while tariffs definitely played a role in copper and gold's wild ride, they were only half the story. There was another, less obvious force at play, quietly amplifying these effects, and it involves something most people never consider. But here's the thing. Those tariffs, while grabbing headlines, were only half the story, and arguably, not even the most significant long-term driver. When President Trump announced that sweeping 50% tariff on copper on July 8, 2025, it came after a Section 232 investigation that explicitly pointed to national security concerns about our material supply chains. It wasn't just about making imported copper more expensive, it was about the underlying vulnerability. The initial market reaction was aggressive, even with the unclear scope of the tariffs. Were they on refined copper, or did they extend to derivative products? Despite this ambiguity, traders started front-running the tariffs. In July 2026, the U.S. saw a record 200,000 metric tons of copper imports, the biggest monthly inflow in 12 years, as reported by IHS. This suggests deep anxieties about future supply, far beyond just a price adjustment. Consider that copper futures, Hg=F, surged by as much as 10% on January 29, 2026, topping $13,000 per ton. Reporter Jake Conley from CNBC even called this unsustainable. A 50% year-on-year increase by January 2026 for copper is a monumental move, suggesting a supply deficit that tariffs alone couldn't explain. The Sprott Copper Report, authored by Jacob White and published on January 23, 2026, also highlighted this record surge, explicitly linking it to supply constraints, not just tariff adjustments. The lesson here is that while policy shifts create immediate volatility, structural supply-demand imbalances are the real long-term power players. So, if tariffs were just a trigger, what was the real force behind copper hitting $6.63 per pound? This next number changes everything. But here's the number that fundamentally changed everything for copper: $6.63 per pound. As of August 5, 2026, copper futures were robustly trading at $6.63 per lbs, showcasing continued strength even after the initial volatility of those tariff announcements. This price wasn't just a flash in the pan, it represented a sustained surge of 7.24% over the past month. The lesson here is that while the 50% ad valorem tariffs certainly acted as a powerful catalyst, they were not the primary underlying driver of copper's record-breaking surge. The real story, the one that Jacob White of the Sprott Copper Report highlighted back on January 23, 2026, was an escalating global supply deficit. This deficit was driven by the accelerating demand for electrification and renewable energy infrastructure. Think about it. Every electric vehicle, every wind turbine, every solar panel, they all require immense amounts of copper. Goldman Sachs had already increased their forecasts based on this long-term supply crunch, a crunch exacerbated by increasingly difficult extraction, a lack of major new discoveries, and geopolitical instabilities affecting existing mines. So, while President Trump's tariff announcement on July 8, 2025, certainly grabbed headlines and prompted a sharp reaction in markets like COMEX copper, it primarily accelerated price discovery, revealing the true, underlying scarcity and strategic importance of copper in the 2026 global economy. The tariffs didn't create the demand, they simply pulled forward the inevitable reckoning with a tightening supply. The lesson here is that macro forces, like the global energy transition, can overwhelm even significant policy shifts. So, while those 2025 tariffs on copper definitely created a seismic shock, pushing prices higher initially and causing that volatility we saw, the sustained record surge in copper, hitting $6.63 a pound by August 2026, wasn't just about trade policy. What we saw was a market grappling with much deeper, structural forces. The massive demand from the green energy transition, coupled with genuine geopolitical scarcity in key materials, created a perfect storm. The lesson here is that tariffs might be the spark, but underlying supply and demand imbalances are the fundamental fuel for long-term price movements in commodities like copper and even gold. Did you find yourself adjusting your own investment strategy after the initial tariff announcements back in 2025, only to see these deeper trends emerge? Let me know in the comments below what your experience was. If understanding the real forces moving markets and protecting your portfolio from short-term noise is important to you, consider subscribing for more deep dives like this. And if you're curious about how these macro forces translate to specific sectors, then you'll definitely want to watch my breakdown of why lithium prices are poised for their own sustained surge next.